Given the current context, and I know you did, so Amanda, for reference, did a really amazing video for TFD where she kind of broke down everything you really need to know about investing during coronavirus. But for those, I mean, and please go watch that after for a very comprehensive exploration. But for those who are kind of wondering, like, why should I even care about investing right now? Like, the sky is falling, everything is ruined, nothing will ever be normal again. Like, why should I even care about investments?
No, that's such an interesting question. It's not the question that I've been getting asked a lot.
Oh, what's the question you've been getting the most?
What should I do with my retirement accounts?
Got it. Well, those people we'll get to. But what about people who are like, this was already for me, like, so not even part of my like realm of understanding. Why should I care now?
Sure. Okay. So I love this framing. This is such a good question. And so where I think I will start is, okay, so when we're talking about investing first, let's make sure that we understand that often what we're talking about when we say markets, there are all sorts of investment markets, but when we say the generalized markets, we mean the stock market. And so just so everybody understands is that is what we are talking about.
Right.
And just to like lay a little bit of foundation, I don't want to, it's helpful to talk about what is a stock first. So a stock is a share of ownership in a company, right? So even just making it super simple, like let's say that TFD wanted to sell shares of ownership in TFD. And maybe you split it up into 10 pieces of the pie. And so one share would be 1/10 of owning TFD.
Right.
And so you could literally buy ownership in TFD. And that's all a stock is. And I think that when we think about investing and like these like crazy markets, something that you can't really hold on to, we lose sight of what it is you own when you own a stock. You own a share or a percentage of ownership in a business. Now, granted, it is a teeny tiny little percentage of ownership.
It's like a 0.00, like
right.
tiny.
It's tiny, but you have to remember it is still a percentage of ownership. Like if you buy one share of TFD, you still own 10%, no matter what the market is currently valuing it at. Now, really quickly, I'm going to shift over to talking about real estate markets because I think it's easier for people to conceptualize with something that provides you tangible value.
Right.
So like this office is providing us a nice, warm, dry place so we can film this. We understand its value. And so let's say, let's talk about a home. Let's say you bought a home for $500,000 and then there's a real estate bubble a la 2008.
Right.
Market crashes and now your home is worth $250,000.
Right.
Would you try to sell the dang thing just because the price is lower?
No, because then you're ensuring that you are taking a huge loss on that house.
Exactly. It would be the exact wrong time to sell. Like what you would do is you would just chill out, like wait for things to come around, reassess in a couple of years, but you understand why you own a house. You own it to provide you with this long-term value, immediate and long-term value.
Right.
If you were really lucky in a place of privilege, you might even be able to think like now would actually be a pretty good time to buy a house. And it's the same idea with the stock market and with buying into the stock market. Now, I don't want to imply that I think that right now is a particularly good time to buy because we did see some volatility in the spring. Over the last couple of months, we had like a really wacky couple of months. March, we saw a crash in the market, but then April sprung back up. And so we're actually very similarly positioned to where we were at the beginning of the year or even a year ago. And so what I don't want to imply is that like we are in some like incredible buying opportunity, but like to answer your question, like what happens if this does get worse? And what if it stays bad for a really prolonged amount of time? Well, from the vantage point of a new investor, that's actually the best thing that could happen. Because when the market crashes, that's a really good time to buy into the market. And the longer the market stays down, it's really counterintuitive. The longer the market is bad, the better it is for young investors who are trying to get into the market. It all depends on the vantage point from which you are looking at the market. Now, that would be a very bad thing for somebody who's trying to live off their investments in retirement, but it is very advantageous for somebody who's trying to build wealth. And I think that this is part of the reason we get so confused about the stock market specifically, because when we talk about the stock market, we use the words bad and good. And a bad market is generally actually a good time to invest.
Right.
So for example, if we have a really bad next 10 years in the market, which there are plenty of highly reputable think tanks that think that we might, and nobody knows. Nobody can predict the future in the stock market, and don't try to do it. And don't trust anybody that says that they can do it.
No.
Please.
They
no.
can't.
Chelsea to the camera, no.
No.
That said, when we look at greater trends in the market, what we do see is that in larger swings, we see the market do really well and then do not as well. And so the last 2 decades are a really great example of that. The 2000s or the aughts or whatever we call the 2000s were not good. We had 2 bear markets, which is a bad market. And overall, if you invested throughout that entire time period, you would have been like, this is bad. This really sucks.
Right.
But imagine that you were buying into the market over and over, and you were being consistent about it, even though everybody around you was saying it's bad, it's bad, it's bad. For those 10 years, you would have felt like you were treading water, but then what happened in the decade after that?
Huge gains were realized.
We saw a huge run up in the marketplace. And so the last decade, the 20 teens, what do we call it?
The teens.
The 20 teens.
The rowdy teens.
They were rowdy. They were weird, that's for sure.
The teens.
Yeah, we saw this incredible run up in the market. And so all these people that spent all of the aughts buying in then got to participate on that upswing. And so that upswing in the teens is what we call a good market. But if you were buying in throughout that good market or at the tail end of that good market, what do we expect happens next?
Yes.
We expect there maybe to be a more tepid period or even a downturn. That's just the way that the market works. We say that it works in cycles, and that's what it means, is that there are going to be good times, there are going to be fruitful times, and typically that is followed by less bountiful times. That's how the market works. And so
that old annoying phrase, the market is cyclical.
It is. It's super annoying.